All right. Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer, and I'm here with Tavi Costa today. Quentin is unable to join us today, but he'll be back next week. So you get me and Tavi. Before we get started, please refer to our important disclosures pages on the screen now. These can be found also on the description on the YouTube channel and on our website. Crescat's live market call is about sharing timely, macro, and newsworthy geologic updates, both the positive and negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist positions. If you want to learn more about our investment strategies, we encourage you to reach out to Merrick.
Did we lose Kevin? Let's give it another minute here. Okay, Kevin's back. All right.
So, not sure what happened. Not much of it did we lose.
Not much. You're about to talk about Merrick. So
Merrick's contact information is on the screen. If you want to learn more about our investment strategies, please reach out to him. So let's get started. So today we got the Michigan survey, consumer survey data that came out, and the consumer sentiment index, fell yet again and disappointed relative to expectations. Survey was looking for 72, came in at 65.6. Now it's been steadily down now for several months in a row, and look at the longer term trend here over the last 3 or 4 years. It's been declining. We are in the territory that is usually a signal of an oncoming recession. And if you go into the next slide, the real interesting thing about the Michigan survey is the long-term inflation expectations, which are at odds with what we saw last week with a declining, or was it earlier this week with declining. With CPI coming in a little bit less than expected, and here we see that consumer inflation expectations are actually higher than they've been, the highest they've really been over the last several years, and especially when you look at the divergence between the mean 5 to 10 year inflation expectations and the median among the survey participants. What you see is there's a big divergence, and there's a lot of outliers, in terms of people expecting really high inflation. How can that be? And it's, how can it be? Well, it's because inflation is high, and it is a major problem, and a lot of the government statistics that measure it are not as reliable, and are subject to all kinds of adjustments and assumptions and different ways that the government has, whether it's hedonics or substitution, to keep the reported inflation down, especially because of the different government programs that are indexed to inflation, like Social Security and Medicare spending. And these cost of living, indices, adjustment factors that are built into the social programs are all based on these government measures of inflation. But what matters about inflation? True inflation. What matters more than anything is consumers' expectations about inflation, and this is the problem. This is why the Fed, has not been able to reduce interest rates this year. We came into the beginning of the year expecting 6 rate cuts, And it was a disappointment in the Fed meeting this week too. There was a hawkish Fed. People thought they were going to have the green light after the employment data, and after the inflation data in particular, that came out. People thought we were going to have the green light for the Fed to start, be more dovish, and we didn't really get it. So this is the problem we have. We really do have inflation that is persistent and stubborn. And once you get it embedded in people's consciousness that inflation is going to be higher for longer, that's very difficult to remove. That it's an inflationary pressure in and of itself. People's actions that they take relative to their inflation expectation. So 5.3% at the high end. So let's move on here. So as you know, I've been bearish. We've been bearish here at Crescat on mega cap tech, on large cap tech stocks. We've been calling for this great rotation out of overvalued large cap tech and large cap growth and mega cap tech and into undervalued commodities. We've been waiting for this for a long time. We're not giving up. Why don't we give up on this thesis? Well, because it's fundamentally sound, and we have the macro data to support it. This is, I talked about this one last week, but I have more data to support what I was talking about, and that is, when you compare NVIDIA today to Cisco Systems at the peak of the tech bubble in 2000, what you see is that relative to GDP, Cisco Systems, which peaked out at 5+% of GDP in terms of enterprise value to market cap in 2000, we have NVIDIA, which is now 11.4% of GDP. Showing a very similar pattern, but an even bigger, bubble, if you will, in terms of how big one major infrastructure technology company can get in terms of its market cap and its share of the economy, relative to all the other spending. This is a bigger bubble, and this is one way of showing that this is a bigger bubble than the tech bubble. And it's not just NVIDIA that has a $3 trillion market cap now. There's two other companies, Apple and Microsoft, that have $3 trillion market cap. So they're also greater than 10% of GDP. And what's the problem with this? The fundamentals, they look good, on trailing, and the PEs don't even look, totally insane. But these companies have record profit share, have record share of spending of other businesses and consumers, overall spending. And people can only spend so much relative to the, there's only so much spending that can go to to one sector of the economy, to one group of companies, until you reach a point where you've had an unsustainable surge in spending and a top. And so this is evidence that we are near and probably right at that top. It's comparing it to Cisco with a 24.3-year lead. And it's we think it's a bigger bubble today. And so let's look at my last slide here, which is the survey that just came out from a group called LucidWorks, and it's a survey of global companies on their AI spending. And 63% of global companies plan to increase their spending on AI in the next 12 months. Well, that sounds pretty good, but inflection is what matters. So that's compared to 93% of global companies in 2023 when they did the same survey, who plan to increase their spending over the next year. So what's the problem? The problem is that the financial benefits of these AI projects have been dismal, according to this study. 42% of companies have yet to see a significant benefit from their generative AI initiatives. So what's the problem? There's been this mad rush of spending, and NVIDIA has been the biggest beneficiary of it, just like Cisco Systems was the biggest beneficiary of it in the tech bubble in 2000. And NVIDIA is the biggest beneficiary today, but it's an unsustainable level of growth. And this is the bigger problem for the economy at large. And there's no return on investment in sight for all of this spending. And so naturally, companies are going to have to dial down their spending. And these are the kind of things that make major market tops. Look, I mean, we have, this is my last slide, but we've had this theme here at Crescat for a while, that we're going to see the rotation out of mega cap growth and into undervalued commodities. We have the setup with rising inflation. We have the setup with a potential, major market, correction coming here at the peak of an economic cycle. But this is a stagflationary economic cycle at the same time as we have this massive deficit spending and these government programs that are going to require more spending on commodities, and so we have the supply demand imbalances. We have the incredible low valuations. We have a killer long portfolio here at Crescat on the activist metals side of 78 companies in our activist metals sleeve, ultra undervalued relative to the resource value of the metal in the ground that our companies have created through discovery of gold, silver, copper, we're positioned, we're waiting, and we think we're really close to this major inflection, this major rotation that we've been talking about. And if you're interested in learning more about this, do reach out to Merrick. So I'm going to turn it over now to Tavi to continue with the macro presentation.
Sounds good. Well, thanks, Kevin. Agree with everything you said. And there's a old saying, I believe it was Sim Zell that said it once, that great opportunities are presented when in industries that need capital. And I can't think of an industry that needs more capital than the natural resource space, particularly the mining industry, and so which has been neglected for a long time. And a lot of investors have certainly has been a conventional thought to avoid investing in this types of businesses because supposedly they don't make any money. But that's true until metal prices begin to rise. And historically, as we've seen, these companies tend to become highly profitable in those times. And so we think that we're going to be facing a very similar environment that we saw during inflationary periods. But today's presentation will be a mix. At the end of it, I'll talk more about commodities and real assets and the opportunity on the long side. But also, I wanted to point out a few things that if there was ever a time to be bearish on technology, I think this time is now. And I think the signs on the wall, you see days like today where technology is still sort of leading equity markets, and you have all these other, I think prior week I had a bunch of different cyclical industries showing weakness relative to the overall market. Today, you can see clearly in this chart that the last month or so of performance have come almost entirely by technology. The rest of the market has been showing very weak performance. And you can see this, across all the other sectors in the economy today. But not only that, if you looked at small businesses, if you look at micro companies, if you looked at even in other parts of the market that used to be more frothy, like ARK investments and other things that have never returned to their peak levels that we had in the past, or transports, which are starting to show, significant weakness, or industrials. Industrials is one of the parts of the economy that are receiving subsidies, and all sorts of investments from large institutions are now underperforming the equity market. And so what does that mean about technology? Can technology continue to be the only game in town? But how long do we see this moving forward? I mean, I think this is completely unsustainable. If there was ever a time to be, taking a bearish stance on NASDAQ, or a bearish stance on S&P 500, or a bearish stance on technology companies, I would say that time is now. And so, here is one chart. Let me drive you through a little bit of the thesis. If we go to the next chart, you can see another one that is very interesting. Technology bubble. When you look at what was the weight of technology sector in the S&P 500 at the very, very peak of the tech bubble. So for those who don't know, the tech bubble really had two peaks. It was at the very beginning of the early 2000s in March, and then at the end of March, more towards the end, which I think was July or August, Kevin might know exactly, was exactly when we had this second peak, the double top. And that peak that you see in this chart is in that second, the double top that we had during that time. And that was when the technology sector accounted for about 34% of the S&P 500 weight. And today, it's at 33%. And so, you may claim that potentially this sector could be even a higher weight of the S&P 500. But I will remind you that technology is eating the world, but we cannot eat technology. I mean, we have to either money flows back into this rotation Kevin was referring to, or the world is just not going to function anymore, because we need new mines, we need new projects, natural resources. We need to operationally run the global economy with other industries that are essential. And ultimately, I think that's why the big problem with this chart, it's not even from a profitability standpoint, although I'd agree with Kevin that the difference between this environment today versus the tech bubble is that the level of spending that we're seeing required to run artificial intelligence models is drastically different than it was with the internet, the beginnings of the internet. And, Jim Chanos was on Bloomberg talking about, just as an example, about the legacy data centers, basically saying all these data centers, they're going to have to be rebuilt. And where's that money going to come from? I think it will come from somewhere, but it's going to have to also be at a cost of some of this profitability that we're seeing, that in our view is highly unsustainable. And so at what moment, have we seen most of that? Think about that phrase I said about where, the opportunity from Senzel, one of the most successful investors that passed away, I think a year ago, a legend in this industry of money management, and especially in the real estate space, and very well known for getting out of the market at times when the market was at a peak. And what he said, I think, really resonates to this idea of today's environment of crowdedness of capital coming into technology. And that's not usually where you see those big opportunities. The big opportunities are where people are not talking about it. And what are the things that people are not talking about? It is certainly not technology. Technology is at the top of the agenda. And just read the Wall Street Journal. It's all about artificial intelligence and all sorts of things happening that are related to this sector that, to me, is gone too big for its own good, in my view. Anyways, let's go to the next chart. So another way you can see as well is this divergence between that I sort of mentioned at the beginning of the presentation of the small cap companies versus the large cap companies. And my question is divergences, they tend to not matter until they do. And one of these two lines, in my view, is lying to us. And I think the big question is which one? And if you ask me, I would suspect that the red line is telling us the truth, because the truth is that the red line basically accounts for 2/3 of the labor market in the US. And so at what moment do we see the real economy starting to weigh on technology? Because the white line you're seeing there is majority technology, because S&P 500, it's a market cap weighted index in which accounts for a lot, for obvious reasons, for the bigger cap names, in which make up majority of this index today. And so at a degree that we've never seen since the 1920s, the late 1920s, before the Great Depression, when it comes to the concentration of mega cap companies relative to the overall market. So when I looked at a chart like this, which has been the case for somebody could argue it's been the case for over a year, but it's getting too extreme. At some point, the red line has to become, at some point, gravity works. And I think we're getting to that degree. And I was just curious, looking at volatility, just for curiosity. And I looked at all sorts of volatility. I looked at volatility in equity markets, small caps, big cap names. I looked at volatility in the oil market. It's one of the lowest in history. I looked at volatility in FX markets, one of the lowest in history. I looked at credit spreads, one of the lowest in history. What does that mean? That means that suppression of volatility just means that the cost for an investor to hedge in this environment is essentially at one of its cheapest levels in history. Why would you not hedge this? I mean, this seems like a no-brainer in my view. But anyways, I do think that there are a lot of things going on in terms of the complacency, in terms of macro indicators that we like to look at, that I believe are starting to show some issues. And the fact that, interestingly, the Fed this week, what did they do? They basically came in a little more hawkish than people expected. First, we had inflation supposedly coming in weaker than expected. And then after that, the Fed comes in and says, no, rather than whatever cuts, we're going to see actually just one cut. I think it was 3 or 2 cuts priced in the Fed dots, not in the estimated market, in terms of imply interest rate cuts. And so what happened when they came in so hawkish? Well, what happened was right after that, the estimates for rate cuts actually increased. And I think the main reason why that happened, and the irony of markets saying, no, I think we're going to see more cuts, basically, even after the Fed came out and said, we're going to be a little more hawkish. And the reason for that is because a more hawkish Fed only adds to the case that we're going to see weaker economic data, most likely in the second part of the year. And so I'm a believer of that. I do think that that's going to be the case. I think we went from 7 cuts to now, technically, we're at 2 cuts priced in the curve. And I think we can easily see the 7 cuts environment back in the game here. Because if we do see a recession, the steepening of the yield curve, all these other signs that potentially could become recessionary signs very quickly, it wouldn't surprise any of the people that have been sort of following these macro indicators for a long time. It could easily make the case where the Fed has to start cutting rates and getting to a panic mode, in which tends to be very bearish for equity markets, not positive, despite this euphoria that we have with investors today that rate cuts are positive for equity markets. Historically, that's not the case. When the Fed starts panicking and cutting interest rates, that means that we're probably about to see a major downturn in the economy. The Fed is usually leading the way to that downturn that we tend to see, and that weakness that tend to then create fragility in equity markets overall. Anyways, let's go to the next chart. And so, interestingly, if you looked at different ways of valuations in terms of the small cap versus large cap names, and you can see that average historically going all the way back to 1985. We're using the forward PE ratio for Russell 2000 versus the Russell 1000. So Russell 2000 is a good representation of small caps. Russell 1000, good representation of larger cap names. And you can see that today we're in a world where the small cap names are one of the cheapest relative to large cap companies that we've seen in history. And notice that in the early 2000s, as the tech bust was unfolding, most of the small cap names actually started to outperform massively the large cap ones. And there were a lot of trends that I think will happen today that is so important to look back during that period. We saw emerging markets outperforming. We saw natural resources outperforming. We had gold outperforming, and we had large cap underperforming, and we had technology underperforming. And so, go back to that environment, and I think we're probably about to see something very similar. The peak of venture capital, the peak of potentially private equity, and all sorts of things that have been very frothy are likely to take a pause, and we'll probably see the revival of other things that have been neglected for a long time. And that's usually what happens with the cyclicality of the business cycle itself, and the economic cycle that tends to create different opportunities every decade or so. And I think we're poised to face those changes here very soon. Let's go to the next chart. And in the next chart is a way of saying, is value investing really dead? Bank of America had a good chart basically showing the French factors for returns and divided into different segments of the market, and showing how small value, not the overall value, but the small value businesses actually were the part of the market that outperformed the most, even all the way back to the 90s, as you can see in this chart, particularly relative to even large cap growth, which is supposedly, and it has done very well, but it's supposedly seen as the only thing that has worked. And there's always room for, in my view, for value investing, and those that tend to take the approach of really understanding fundamentals in order to deploy capital. And I think this has been forgotten recently, especially by this new generation investing in crypto and also meme stocks that tend to not actually. And the funny thing is, actually, if you listen to Roaring Kit, or whatever his name is, Keith Gill, or Gil Keith, I don't know which one is his first name. I suspect that Keith is his first name, but funny enough, if you listen to his pitch for GameStop, it was actually a very value-driven approach at the very early stages. And now that we have, the valuation of GameStop at, such absurd levels relative to their actual business, I think somebody was pointing it out that, tens of billions of dollars in terms of the enterprise value of the business, on a business that is making, I believe was like 60 million on EBITDA. So, what type of multiple is that? I mean, you can do the math. It's insane. So, and things so kind of, broke out from reality in terms of the disconnect of fundamentals versus prices. And that's just an example of other things. And I think Jim Chanos actually made a point that is important here. Other meme stocks, outside of GameStop have already collapsed and never return. And so, GameStop is having its own phenomenon. Basically, it's not really a thing that is spreading around other things, but I think it's interesting to see regulators going after them, because in my view, when you think about what caused this whole issue, was actually government policies, was too much money printing, was too much of a period with low interest rates that creates speculation. And so, it's just a consequence of the system, in my opinion. Let's go to the next chart. And so, one interesting aspect that, again, one of those things that we look at in terms of, trying to time the business cycle, trying to understand some macro indicators that likely lead to, especially deterioration in labor markets, that could lead to also, particularly, a policy in terms of the Federal Reserve and others. And in this case, we're looking at job openings, which have been declining. If people have been paying attention to job openings over time, they usually decline before a recession. As a recession unfolds, people start hiring less and less. But more importantly, because of this trend of a declining in overall job openings, we actually tend to see government jobs become more of larger part of the pie relative to other private companies and public companies that tend to hire people. And so what we're seeing is that other companies are basically not hiring as much as they used to, in which it's making the government become a larger and larger percentage of job openings, which is something that usually happens in a recession. Usually the government becomes more and more relevant in terms of job openings as we see a recession unfolding. And this is a trend that maybe started in 2021, as you can see in this chart. It has been going up, and it's been very established move, as you can see here. These moves are usually, very clear and evident. And I think this is another one of those. And most likely we're just at the beginning of an upward movement in government jobs as a percentage of total job openings. Let's go to the next chart. So in the next chart, we're looking at small businesses surveys and seeing what is the single most important issue for a small business. And the reason, again, I'm going to small businesses is because first, we looked at the divergence between large caps and small caps. I made a point about how I think that small caps are the ones probably telling the truth versus large caps. And I also made a point that 2/3 of labor markets come from small businesses. And so in this chart, you're looking at a survey that basically asks those companies, what is the single most important issue in your business today? And the answer that comes to mind, as you can see here, is, first of all, quality of labor. They're having issues finding good quality labor. But the second thing is inflation, which is the orange line. So orange line represents inflation. And you can see that inflation usually is not a problem that tends to happen during, unless you're talking about in the early 80s when we had the double dip recession caused by stagflationary environment. So this is stagflationary at its nature when you look at this research. And you can compare this with the global financial crisis, which, I always argue, and I think Kevin too, that this is very remarkably different than the global financial crisis and what we saw with the housing bubble. And the main reason is because that period was a very much more of although we didn't really see deflation, was a more per se a deflationary shock in terms of how things unfolded. And today it's much more stagflationary, and you can see this in the surveys right now. And you can see as well in the yellow line there represents that the single most important problem was sales. And so back in, leading up to the global financial crisis, sales was a big problem for the small companies until we saw things collapse. And today, maybe this is starting to increase, and I think it will. I think sales and the downturn in the economy eventually creates that becoming an issue more and more for those companies. But still, inflation is clearly very highly. Forget about the government data and the way they are calculating inflation. You can see clearly here that these small companies that are a large part of the economy are continuing to complain about the inflation issue being the single most important problem for their business. All right, let's go to the next chart. And so you can see today we had, U.S. export prices, first increase that we've had all the way back from a while. I believe it's since December. December was a prior time that we had a positive year-over-year change. Now, these are important segments as well, which is a little bit in contrast with some of the other data that we haven't seen this clear, trend of upward that we're seeing all the way back to June 2023. It's been a very long time since we've had this indicator actually turning positive. And so, I do think that there's something to do a little bit with the base effects, but there's a lot of inflation still in the system. And the U.S. actually exports a lot of energy products as one example. And that's probably one of the reasons why we've had an increase here. But I'm going to talk more about inflation later on. Let's go to the next chart. The ECB here recently had to, cut interest rates as we saw. I think it was Elizabeth Warren that actually wrote a paper, or I should say a letter to the Federal Reserve prior to the Fed's release of their decision on interest rates of keeping it unchanged, and requesting the Federal Reserve to reduce interest rates because of the impact that we're seeing in the economy. arguably very political, but that's not my point here. My big point is to talk about what's been happening as well. And she claimed that, look at the ECB. The ECB is also doing this already. And that's an interesting point because the ECB had to cut interest rates, but at the same time revised their inflation numbers higher. And, one may say that that's a measure approach and so forth. I don't want to get into the weeds of what that means in terms of the, how policy is being adjusted relative to the neutral rate and so forth and where they think it should be. But really the point is, it reemphasizes the idea that most central banks are trapped. Now, the ECB, Japan, and most of those economies, because of their level of debt being drastically higher than the US, they've been dealing with this problem for a longer time than the US. And therefore, they are more used to how to at least respect the fact that they don't want to mess with upward movement in interest rates that essentially will bite them on the back immediately. And, interestingly, if we go to the next chart, I think it's this chart. Let's see. I put together this chart because I think it's a remarkable way as well to explain, this idea that the Federal Reserve is trapped, that the U.S. and other developed economies are going to face big issues. Now, notice here, we're looking at net interest payment relative to GDP. These are estimates by the OECD that essentially show you where the net interest payment of relative to GDP will be by the end of 2025. Okay. And you can see here that the U.S. is about 4%. I think these estimates might be actually off, and it could be even higher in the U.S., for instance. But what is the most important thing here? The most important thing here to me is comparing this with a country like Japan. And when you look at Japan in this case, Japan is at 0.1%. And you may think, how in the world is Japan running a net interest payment to GDP that is so low? Well, the answer for that is because first, they've been running a negative interest rate environment policy for a long time. And number two, despite all the increases in interest rates that we've seen across most economies, Japan has been the one that's been the most reluctant to raise interest rates and claiming that they're not seeing inflation. While I do know a lot of Japanese people, and they do say that, we're not facing the same inflationary problems that the U.S. is facing in other developed economies. Now, I would say that the inflation metrics in Japan as of the last 1 to 2 years have been drastically different than the prior 2 decades. So let's put it that way. I think that there is a big difference in the data and the cost of living in Japan itself. But the main point is that the central bank, the Bank of Japan, is well aware. Boy, if we raise interest rates, what happens? We're going to kill this economy. And, the fact that they have to reinforce financial repression constantly at the cost of the currency, but at the same time, in order to allow the economy to supposedly grow and deleverage over time. And I think the U.S. is going to face exactly the same problem because, Japan is almost like living ahead of us. Although I don't think it's, used to be a few decades ahead of us. I don't think it's a few decades ahead of us anymore. I think we're actually quite close to each other, despite the fact that Japan is a little bit ahead of us in terms of their issues and how the U.S. is going to have to be facing these issues. If you think about this, net interest payment relative to GDP in the U.S. is the worst country in the world today in terms of this metric. In other words, the U.S. is paying more. It has to grow 4% of its GDP in order just to pay down its net interest debt payment or service the debt. And the importance of this metric to me is really on the FX side, because if you think about it, what is the resolution of this? This large number relative to other places in the world is that the U.S. is going to have to at some point deal with this problem with a much more aggressive way than the other countries that have not been facing the same imbalance. And what does that do to the dollar? Now, I would suspect that that's not going to be positive. And so now I'm paying close attention to this because I think it's going to have some major ramifications in the FX world very soon. And so this is a very important chart. I will point out this chart in different ways because I have other ideas of how to present this data even better. But I think this is one of the most critical charts I've seen even this year, because at least to reinforce my opinions, and it's not just because it's my chart. The second best chart I've seen this year is the immigration chart, which is not my chart. It's an incredible chart that shows illegal immigration surging in the U.S. I suggest everybody to be aware of that chart as well. But these are types of things that kind of reemphasize the thought that I think the U.S. is going to be facing, which is further inflationary pressure, allowing inflation to be higher for longer. And what is the impact of that in the cost of capital, but also the impact of that potential migration of money back into industries that tend to do very well in an inflationary era. And to me, that's what the idea really comes from, to invest in natural resources. Let's go to the next chart. Boy, I'm going a little long. Luckily, Quentin is not here to do a presentation as well. But here's an interesting thought about China. I've been looking at, I haven't done a lot of research in China recently. I do a lot of research in China, but I used to really dive in the Chinese economy and look at the data and so forth. One thing I noticed that I think it's also very interesting and meaningful relative to other developed economies. I should say, shouldn't call China a developed economy necessarily, but other large economies, is the fact that we are seeing interest rates going up. But in China, we're seeing this trend going lower. Not only lower, one of the lowest levels in the last few decades. And if you go further on this chart, you will see it too. And the Shibor rates is essentially the Fed funds rate of China, just to give you a sense of what this is. And it's their policy rate essentially, or not exactly the policy rate, but what you're seeing here is another one of those consequences of a highly levered economy that is being forced to reduce their interest rates and their cost of debt in order to survive. And that will come at a cost. The cost of that is usually the currency. There's a reason why China has been accumulating gold, in my opinion. It doesn't make China, to me, an investable place or anything like that. It only shows to me that the imbalances in the Chinese economy only re-emphasize and reinforce the case to buy gold, because most economies will be facing similar problems, particularly the ones that have high debt. And they're going to be facing this idea of always resorting back to financial repression. In China, Japan, those are great examples of economies that are, facing these issues. China facing defaults, and the Chinese banks having issues, and they had issues years and years ago, and the real estate market and so forth. So, it is clear that reducing, and I think China is having its '08 moment. It's been having its '08 moment for a while. And it's likely to be facing something like Japan faced after the 1990s, which is a period of not necessarily stagflation, but perhaps a stagnation. And that means, that usually comes at a cost, and the cost usually is the currency. So ultimately, when a currency starts to deteriorate its value, it reinforces again the need for a central bank to enhance their quality of international reserves. And therefore, why I think we're seeing this trend of China buying gold, the China gold rush that we called in our prior letter, and in which I think is just beginning. I think we're going to see this across other, even more across other central banks, because it's, they barely own gold relative to history. Let's go to the next chart. Next chart is looking at the credit picture in China as well, just to give you a sense. And the total social financing is basically a broad way of looking at credit in China, and we've seen this first decline in the history of this index. And so it's another example to show that China is trying to do everything they can to not devalue further their currency. And one of the things they've been trying to do is trying to crimp down on the credit creation, which is usually measured by total social financing index. And that first contraction that we see throughout history is very telling by the fact that they've been facing all these issues with their downturn in their own economy and domestically speaking. Let's go to the next chart. And to me, I think the big story of this prior weekend was the fact that people were claiming that China stopped buying gold, and that was, just to me, just one of the most premature conclusions that the Western media has taken that I can recall, because there hasn't been any statements from the PBOC that I am aware of. If you know of one, please send it to me, but I'm not aware of any statements from the PBOC that they claim that they're not buying gold. In fact, all that happened was that they reported their gold holdings, official gold holdings, unchanged from the prior month, relative to the prior month. And, if you ask me, who knows what they're doing unofficially as well in terms of not reporting purchases of the metal, because if you just do the math in how much gold has gone up and the size of the gold market, to see a type of movement we've seen recently would have been explained by a lot of undisclosed purchases by central banks. What we've seen so far is not enough to see that push in markets, because we know for a fact that vehicles like GLD and others are just not seeing the inflows either. And so, the flows have to be coming from a larger institution that is likely, buying gold in a big way. And you can see in this chart that the blue bars is looking at the gold holdings officially reported by China, which, looks clear to me that the trend is higher. And the second thing is looking at the interest rate, the currency performance relative to the dollar. And so as the white line increases, it means that the currency is devaluing against the dollar. And I think that pressure is what also adds pressure on the PBOC to add to the blue line. And so I think there is despite the ups and downs, I think there's a long-term correlation of the trend of the two, which is, upward, more devaluation of the Chinese yuan, further buying of or further accumulation of gold in their balance sheets. I think that's clear until a point that we see the balance sheet quality improving so drastically that it changes the game as well, potentially. Let's go to the next chart. And so you can see that in that aggregate all these speculative positions in futures today in the US dollar. Interestingly, we're seeing one of the most bullish positioning environments that we've seen in a while for the US dollar, which usually, as you can see, the dark dotted line in this chart is actually the dollar performance. You can see that a lot of times when this bars in red tend to peak, usually also in line with the peak of the dollar. And today it's definitely more pronounced. And you can see that the bottom there in 2021 actually happened at a time when speculative positions are very short. And so, how do you see a squeeze in a market? Well, from extreme positioning, right? And I'm talking a squeeze on the long side or short side. And in this case, the squeeze is likely to come from hard assets, which is the other way of this trade, right? I mean, if you're, yes, gold can rise with the US dollar. I don't disagree. We made that point many times in our letters in the past. We even called it the macro trade of the century, which was gold in Chinese yuan. And I still stand by that idea. I think it will be the macro trade of the century. But the point being that what I think it's happening is that when the dollar weakens, it certainly is an additional factor to hard assets to do very well. So if we know positioning is very extreme in the dollar, most likely we're close to a turn even further of commodities doing well. And this is reflective as well. If you looked at oil markets and other markets that have been kind of consolidating for some time here, and they're going to have their other phase that the metals have been having recently. Energy is going to have their other phase most likely here soon because commodities rotate. Let's go next chart. This chart is, to me, probably one of the most relevant charts of this presentation. It basically looks at silver prices going up. Who would have thought that the market would basically go from 7 cuts in terms of the implied rate of the Federal Reserve, the Fed funds rate, to 2 cuts? And if you think about this, that's a very hawkish shift in the market, right? The market stance has been ultra dovish to now, rather than 7, we're going to see 2. And then who would have thought that silver would just take off? I mean, to me, I think this is one of those things that, the markets do to you that, it's completely unexpected by a lot of people. And if you tell somebody, hey, the market is going to go from pricing in 7 cuts to 2 cuts, even if you ask me, I would probably said, wow, that's a big change, and while I was in that camp that I thought was too much seeing 7 cuts because I thought inflation was going to reaccelerate, I also wouldn't think that silver was going to surge the way it did recently. In fact, what is remarkable is to see silver actually being, really oversold right now at $29 an ounce. I mean, that's I think that's remarkable too, because we just haven't seen, a market that has been more supportive for the metal in a long time. And despite the sentiment that has been now flushed out significantly since the 2-3 weeks ago already, which is great. I think we're getting ready for another upward movement here in silver prices, and I love seeing this flush out and now reestablishing itself at a $29 an ounce. I mean, think about how many businesses that produce silver, how the profitability of those companies will change. Especially with silver potentially bottoming near these levels and heading much higher in prices, at least in our view. Let's go to the next chart. U.S. family offices. If you look at the strategic asset allocation of these institutions, they barely own commodities. That's the truth. And somebody, told me, well, actually, this is not including gold. Gold is about 0.8%, 0.6% of an allocation today in this U.S. family offices data from the UBS, and CNBC was the one that actually made this chart initially. I did look at the chart, the data myself in the UBS report, and it's it's remarkable. I think there's so many takeaways from this chart. Number one, like I said, and I circle in this chart, these institutions barely own hard assets, right? If you think about commodities, at least as a hard asset, maybe housing market would be, arguably something else, because you can see there it's about 10%, but commodities barely owned by these companies. And we know the commodities market, will change quite a lot as we see allocation coming back. And, if we had a version of this chart back in the 1970s, or maybe let's call it mid 70s, late 70s, I would say U.S. family offices probably look completely different and probably had a significant amount, maybe 20-30% of their book was in commodities as well. And I'm talking, adding commodity producers and other things. In this case, right now, we see 28% of equities plus another 35% of private equity. So where do you think the money is going to come from to come to commodities? That's the rotation Kevin was talking about. That's where it's going to likely come from. It's going to have to come from one place to feed the other, and it's likely to be in the commodity spaces. That's why, I see this chart. The first word comes to my mind is opportunity. The second word that comes to my mind is asymmetry. And so, this really important data. When you're having a bad day and commodities are not doing well, look at this chart, because the short-term volatilities, they don't matter over the long term. If you set up a strategy to really take advantage of these long-term macro trends, I think that's really where the big money is made. And so I think this is a really good, interesting type of metric. And by the way, don't forget, 60-40 portfolio is an even broader measurement of capital strategic asset allocation. Also looks like this. And there's a reason why it's called 60-40 is because it doesn't include commodities. It doesn't include gold. I think that especially in the 40s, the fixed income, we're probably going to see, gold becoming a more defensive asset. We're probably going to see commodities taking part of the equity side. Commodity businesses are probably going to be part of that. Emerging markets are probably going to become a part of that too, because majority of the capital is in U.S. stocks. And then you think about the third pool of capital, right, which is central banks that barely own gold today. They own, who's holding the bag when it comes to fixed income? Central banks. They own, 80, 70%, depending on the central bank, of their balance sheet is on essentially on sovereign debt. European treasuries, U.S. treasuries, European fixed income securities, Canadian, Japanese, all sorts of things. They've been financing each other's economy for a long time, and that game with deglobalization is in my view, being undermined, and probably we're in the process of seeing the dynamic shift in a big way. Let's go to the next chart. And so you can see here commodities long-term. This is Incrementum AG chart from In Gold We Trust. Great report. If you haven't read it, you should. But what is interesting about this chart is this, this huge cycles in commodities, and look where we are. We've just seen a very small portion of what I think it's going to be coming here soon, which is one of the biggest movements in commodities. And why do I think this is going to be an even bigger cycle than prior cycles? I think the main reason for that is because how depressed capital has been, how neglected. I mean, if you think about history, and all the way like less 130 years or so of history, let's just say that because we can measure that more appropriately. And we think about the size of the commodity space and emerging markets and gold itself, and relative to the global assets, private equity markets, large cap names, and all sorts of things. And you looked at that, real estate, I don't think we've ever seen a market that is so ignored for so long, and it plays such a vital role in the global economy, like we're seeing today. And if you ask me, the cycles of commodities tend to take a long time because of how long it takes for you to deploy capital and then get to an increase of supply of that commodity over time. It takes a very long time. In the mining space, it could take up to 15 years. So think about that. If capital is not entering the space today to increase supply 15 years from now, then what does that mean about the length of the potential length of this cycle that we're probably entering? And the fact that the more I look at that chart of technology being such a large weight of the economy, the first thing that comes to my mind as well is the fact how much of electricity consumption is going to have to come from all these AI developments and technology as a whole. And I can't imagine, like, the more Nvidia goes up in prices, the larger it gets into a market cap size. I would suspect that the larger the opportunity in the commodity space. And I'm not here to say that Nvidia needs to be going higher in order for commodities to go higher. I'm here to say that it gives you a sense of the size of the market being priced in today. It has to be translated into also a much larger redeployment of capital into commodities and natural resources and so forth. And supply of that needs to shift, drastically in order to accommodate all those changes. Let's go to the next chart. I think I'm almost done. Brent oil is, as well as I pointed it out, I'm going to go 3 charts on oil. I think, as you can see, positioning the same way oil, the dollar is overbought in this calculation. Now, this is oil being, near record bearish positioning, meaning, usually, investors want to be buying things when majority of the market is a skeptic about a certain part of the market. And you can see here that back in during times when oil turned negative, this indicator was also extremely bearish. And so I think that this is another really interesting setup is how energy companies and energy overall is starting to show some some signs of extreme oversoldness, and not only that, but also cheapness in terms of the valuations, and also now positioning in terms of the future contracts of energy commodities overall. Now, I pointed out natural gas not too long ago. I think that gas, depending on the contract you're looking at, it's up over 50% already. And so think about that on an inflation front as well. And what it's remarkable, if you go to the next chart, you can see the forecast for Goldman Sachs and others. None of them expect that we're going to go to the prior highs that we had in oil. And I think it's very plausible because we understand that we still need oil, and we understand that the demand is still really high. We understand that ESG policies have only exacerbated the the supply problem that we've had, especially recently. And now I would say that if there was ever a time when oil should be seen as a strategic macro asset, that time is today, because clearly we're seeing escalating geopolitical issues, and oil is one of the most important commodities any nation should own. And so I think that this estimates are another way of thinking about sentiment. I think sentiment is way too bearish. Let's go to the next chart. As you can see as well, oil, it would have surprised me, even technically. If you look at oil, it's been, sort of hit this line a few times all the way back to 2021. The peak of the market was really in I think it was March or so of 2022. And it's been declining since then. It's been, it reminds me of the silver market 2 years ago. And then silver market just took off recently, right? And I think the same thing is oil. It's been doing this, higher lows, as I pointed out in this chart. Would it surprise me if it breaks out at some point? No. What would cause that? I don't know. It could be a geopolitical problem. It could be a war. It could be so many things. It could be nothing. It could be just a repositioning of the market. And, but the fundamentals are there to support a breakout. And that's what I pay attention to, because I find it's hard to believe that we're going to see an inflation problem that is not also led by energy. And so energy is on top of my mind all the time, because I do think that's essentially the way you play inflation. Let's go to the next chart. I'm almost done. Agricultural commodities is my last point. Agricultural commodities, people made fun of, first when they went up, everybody was scared. When they went down, everybody made fun of it. But really, we just retested the highs of the Russian invasion period. And now we bottom at that level, and now we're going higher again. And what is the thing that comes to my mind when I look at a chart like this? Here's the next chart, my last chart, which is food prices. If you look at food prices relative to agricultural commodities, you would think that at some point higher commodity prices will translate into higher food prices. And if there's something inflationary to the consumer, I don't care about CPI in this case, and I don't care about PCE and other metrics by the government. I'm talking about an individual that has to pay their bills on a monthly basis. Now, those guys, especially lower income people, food prices matter. And, when I looked at this chart, I think it's scary, because I do think it's highly likely that this green line will lead along with the yellow line, because commodity prices should lead to higher food prices ultimately. And so, it's something to pay attention to when you think about inflation expectations, which in our view remain even still too low. I know Kevin showed a chart of inflation expectation rising, but even, from that perspective, it's very low relative to history. And we think it could be a lot higher, and that could change the dynamics of the markets. All right. Well, Quentin didn't have a presentation, so I spoke way too long, but I hope you enjoy this presentation. This was kind of by design, because I knew Quentin wouldn't speak, so I took advantage to go a little longer. Kevin, any final remarks?
All right. Thanks, Tavi. Good stuff as always. And look, today we have 4-to-1 decliners to advancers in the markets. And guess what? Gold and silver are up. So, yes, people say, what's going to happen when stocks go down and the market goes down, and aren't gold and silver going to get crushed as well? No, not in a stagflationary type of an economy. And that's when you see commodity prices and commodity stocks going up, when the broader stock market is going down. And we still think that's the type of environment. Yeah, it's just one day, but it's I think we're going to see a lot more days like this, where we see commodity prices up, gold and silver prices up, and gold and silver stocks up, with with the broader stock market and indices going down, especially these hyper overowned, overvalued mega cap tech stocks. We're still looking for this rotation, and I think it's we're positioned for it, and I think it's going to be coming. If you got any more questions for us, interest in our strategies, want to learn more, please reach out to Merrick. His contact information is on the screen now. And we'll be back next week with Quentin. And that's all I got.
All right. Well, I was laughing because we don't get to call the top anymore, Kevin. Both of us have done
I
it too
know
many times.
we don't get it all, but doesn't mean we can't be positioned for it, and doesn't mean we can't ultimately profit from it in a potentially big way. So
This is, by the way, a joke, but yeah, Kevin knows it's a joke for other people that don't know. All right. Well, Quentin will be back next week. So for those that were frustrated that Quentin wasn't able to share and you had to be bored listening to the macro stuff, that's okay. Next week he'll be back, and I'm sure he's going to have some really good stuff to share with you. But thanks everybody for watching. And again, if you have any questions about Crescat, you should contact Merrick. I think this is a very pivotal moment we're seeing in the global economy, and more reinforcing the idea of owning hard assets. And what we're trying to build is something very niche, I would say, and something I would say a lot of folks are not attempting to do. And I think this is a very interesting way, and I love it. I mean, I think it's the best way to be playing this commodities cycle that we believe so strongly will be unfolding here for the next decade or so. And so if you have any questions, you would like to learn more about the metals and mining industry, or if you'd like to know more about our global macro positioning or the long short positioning, now I highly suggest you to speak with Merrick. But thank you everybody for watching. We'll be back next week. Quinto will be back as well with us next week. And subscribe to our channel if you haven't yet. Thank you.